Her name is Kilty. She has paid her student loan every single month for 10 years. She did everything right. 15 payments left. Then the rest is forgiven. In December 2025, the program she was counting on got frozen. "Are you kidding me?" she told NPR. This is not a story about irresponsibility. It is not a story about someone who borrowed more than they could afford. It is a story about a design, a specific design, that was built to do exactly what it did. By the end of this video, you'll know how a loan balance can grow while a borrower is paying it down every month, on time. And you'll know who built it that way. In 1965, President Johnson signed the Higher Education Act. The idea was simple. If your family couldn't afford college, the federal government would lend you the money. You'd go to school, you'd earn more, you'd pay it back. The loan was the ladder. And for a while, the math worked. In 1980, a year at a public university cost roughly $3,000. A minimum wage worker could cover it in 9 months. The loan was a bridge across a short gap. Then tuition began to grow, faster than wages, faster than inflation. The gap got wider, the bridge got longer. But the promise stayed the same. Borrow now, earn more, pay it back. Nobody changed the brochure. What changed was the math underneath the promise. And that's where this story starts. Not with irresponsibility, with arithmetic. If the math changed, what exactly happens inside the loan? Here's how a federal student loan actually works today. Most borrowers pay based on their income, not the size of the loan. For some, that payment is small. Sometimes it's $5 a month. But the loan still charges interest every month. If the payment is smaller than the interest, the difference doesn't disappear. It gets added to the balance. The balance grows, even though the borrower paid, on time, every time. Put numbers on it. Someone earns $35,000 a year. On income-driven repayment, their monthly payment is around $89. But their loan charges $150 in interest that month. The difference? $61, added to the balance, every month, for years. This has an actual name, negative amortization. The Consumer Financial Protection Bureau describes it in its own borrower guidance. It is not a glitch, it is how the plan is designed to work. That's the mechanism. Chapter 3 is who benefits from it. If the balance is growing, someone, somewhere, is collecting the difference. Borrowers don't deal with the government directly. They deal with a servicer, a private company paid by the government to manage the loan. The servicer gets paid whether the loan is going well or not, whether the balance is falling or rising. The incentive is not repayment. The incentive is management. One servicer, MOHELA, has been paid more than $1.1 billion since 2011 to staff call centers and help borrowers. In 2024, a Senate report tied the same servicer to nearly 4 million billing errors during the return to repayment. At the hearing on those failures, the senator chairing it didn't mince words. Every single student loan servicer failed to adequately prepare for the transition. That's not a theory. That's in the filing. Meanwhile, the company servicing nearly $500 billion in loans reported tens of millions in profit on that business in a single quarter. Getting paid isn't tied to whether your balance ever goes down. It never was. There's a name for what happened to mortgages in 2008, when the people originating the loan got paid regardless of whether it was ever repaid. Economists called it a misaligned incentive. They gave it a different name when it collapsed. If getting paid doesn't depend on the loan ever being repaid, how large has this actually become? As of early 2026, Americans owe $1.87 trillion in student loans. $1.69 trillion of that is federal. 42.8 million people are carrying it. Hold that number. It comes back. And this isn't spread evenly. A Federal Reserve-based analysis found that 52% of black borrowers who didn't consolidate their loans owed more than they originally borrowed within 12 years of starting college. Take a second with that. 10% of all federal loan dollars are delinquent right now. New borrowing added another $102.6 billion last year alone. And the average borrower doesn't owe what they originally borrowed. They owe what the mechanism turned it into. That's not a footnote. That's 42 million people, 1 in 8 American adults. And finally, in 2025, the system itself admitted something had gone wrong. If the government's own data shows this happening, why did it take this long to change the design? In 2025, a court struck down the repayment plan that had paused this exact problem for millions of borrowers. Interest started accruing again that August. Balances that had been frozen started growing. The mechanism came back. The replacement plan, launching in July 2026, does something specific. It waives unpaid interest automatically. The balance can no longer grow past what was borrowed. That single design change is an admission. Governments don't usually say the old design was wrong. They just build a new one. This time, they built a different one. And here's what nobody says out loud. None of this fixes what already happened to borrowers under the old design. The new plan starts in July. For the borrowers still in the old one, the ones who paid every month, on time, for years, it only stops it from happening to the next person. There are 42 million of those people, and they are still there. If the new plan finally stops the balance from growing, what happens to everyone the old one already caught? Even if you never took out a student loan, this touches you. 42 million people are delaying buying homes, delaying saving for retirement, delaying starting families. Not because they're irresponsible, because the math they were handed on the day they signed was not the math they were promised. An economy with that much deferred life moves differently than one without it. Slower savings rates, slower housing demand, slower wealth accumulation across an entire generation. That is not a borrower's problem. That is everyone's economy. Back to Kilty. 10 years of payments, 15 left. A balance that may have grown for reasons that had nothing to do with anything she did wrong. She did everything the promise said to do. She went to school. She paid every month. She waited. The infrastructure to fix this now exists. It starts in July. It does not reach backward. Whether the new design is fair to the next generation of borrowers is a policy question. Whether it's fair to leave 42 million people behind, it is not. Systems explained honestly. Subscribe if that matters.